economist. You are a big picture thinker. You think in terms of what the Fed is going to be doing later this year, not necessarily what it's doing today. Yet, when you look at the markets and the violent selling that we're seeing, not just today, but throughout the week, if it's not fundamentals, what is driving these losses?
Well, clearly it began with flows, not fundamentals, but one has to worry about what George Soros has famously called reflexivity, where movements in markets can begin to have some sort of feedback loop onto the economy. Now, recall that this happened after China on August 11th devalued its currency when it tried to make its goods cheaper to the rest of the world. There was a cratering, you could say, of markets. They didn't fare well, but they snapped back, and the Fed eventually raised interest rates. We would suggest that that's likely to happen again, but would be a little bit leery, of course, and wanting to be looking to stay up in quality. Now, what's happening more in general is that the world is trying to adjust to a new foreign exchange regime. One could argue that there's been one in place since 1971, a free-for-all, 1971 when the Bretton Woods system was put in place, a free-for-all where markets set prices. But here it is where China, now part of the IMF currency basket, about 10% or so. It's becoming part of the FX regime globally, but there's some state control. And in this state control, there's uncertainty. Markets don't know and they don't like. They don't know what, they don't like uncertainty, and they don't know what China will do next. And that uncertainty breeds a disengagement from activity in markets. Eventually, markets will get used to this sort of thing. But for now, it's an adjustment process. It's an entirely new FX regime to have some form of state control in it as much as it is right now.
So this is still a carryover from the August evaluation, and I like what you said about the world adjusting to a new FX regime. Is there a currency pair that you would look at as a key driver, as a first mover?
Well, Pimco projects and has been projecting a bigger decline than the markets have been priced for in terms of the Chinese yuan. Markets a few months ago were projecting declines of just a few percent for the year ahead. Pimco is projecting in the high single digits. We're still there, but markets are moving toward that. But markets are entertaining the idea that perhaps there'll be more. And that's the idea. The there will be is a phrase that represents some degree of uncertainty because it's not been made clear what China will do, whether it'll shift from focusing on its currency as it is valued against the U.S. dollar, or a basket of currencies that reflects its trading partners, the activities it has with its trading partners. It hasn't made that clear yet, but it does have a huge arsenal of reserves, over $3 trillion from you and I and others buying stuff that says made in China for years. It's built up lots of money. It had $4 trillion. It's down to 3.3. It's spending $100 billion a month to try to keep its currency up. And that's one of the problems. So it has three choices, three different regimes, perhaps. A crawling peg, let it move very slowly, but that's costly, 100 to 150 billion per month. A managed float where they kind of guide it down a bit more, that may be 50 to 100 billion in cost, or let it float freely. That's probably the last choice, and one that would be too much of a free-for-all for now. If there's one solution, maybe markets will hope, but it won't likely happen. There's not even talk of it. A Plaza Accord type thing that happened in 1985 when the Globe said, let's devalue the U.S. dollar a little bit. Not likely now, but something, if it ever got really unstable, some in markets might begin to think of. But right now, it's all in the hands of the Chinese to communicate what it is they'd like to do next.
Okay, well, they have that opportunity this weekend. We have a 3-day weekend coming up for traders and investors here in the United States. There's some concern that maybe China will announce some kind of policy decision or take some kind of action over the weekend. What kind of risk is that for markets as we head into this 3-day weekend?
Well, just the phrase 3-day weekend when markets are falling creates a lot of nervousness and anxiety. It's not the sort of weekend, though, where information will flow out to change the equation. If anything, if there is information flow, it would more likely be to the positive. The only negative would be a lack of information, as I've been suggesting. Markets are sort of in the dark as to what's next. And right now it's pretty much flow-driven. Flows can exhaust themselves, though, and that's the caution for investors who want to get out of risk assets now while the U.S. economy is still performing reasonably well, and the European economy seems to be as well, and Japan moving as it has been for quite some time. This sentiment is so poor that perhaps they'd be selling at the lows, and the adage is that you make your fortunes when markets are down and should be considering purchases of riskier assets now. By riskier, it doesn't mean risky, highly risky, but just more risky than U.S. Treasuries.